Good afternoon. I'm very happy to introduce the funding ETA Strategies that will be led by Kevin Butts. If you have any questions in the end, Brandon in the back will be able to help you out. He'll be our mic runner. Thank you.
Great. Thanks so much, Andrew. It's great to see everybody. I'm Kevin Butts. I'm a vice president at 50 South Capital Advisors, which is a private equity fund of funds and direct investor. We're wholly owned by Northern Trust Bank, so we work a lot with high net worth investors and private business owners, and I lead our buyout fund investments as well as our co-investment effort, and so also directly working with entrepreneurs and family founder owners on a regular basis. But we don't, at 50 South Capital, directly fund the lower, true lower middle market ETA type profile businesses, but we've assembled an esteemed panel of four industry participants that are on a day-to-day basis involved in ETA funding, whether that be through management buyouts or directly working with searchers and otherwise. And so it's great to see everybody. I'm a Chicago Booth grad. We've got a few Northwestern grads here as well. But what I thought we would do to kick it off is have the panelists introduce themselves and the firm that they work with and at, and also give you a little bit of insight into what facet of the ETA industry they touch from a professional perspective. And then we're going to get through a handful of questions, but we definitely want to make this an open discussion. We will certainly leave time at the end for questions, but if we're on a topic and you think that there's another level that we can go deeper and you've got a question before we move off it, don't be afraid to raise your hand and we'll get to it. We want to make sure it's an interactive conversation. So maybe I'll turn it over to Nick to introduce himself.
Happy to. Good afternoon, everyone. My name is Nick Stone. I'm with Cyprium Investment Partners here in Chicago. Our group has been making investments alongside founders, entrepreneurs, management teams, and independent sponsors for the last 20 years. We've completed 75 what we define as non-control investments during that time, typically in companies with 8 million or more of EBITDA. So when you think about entrepreneurship through acquisition, for many of you, that means the search fund model. And that doesn't preclude you from working with us. It's just usually searchers are looking for companies with 500,000 to 3 million of EBITDA, maybe not 8 million of EBITDA. Most of my answers today will be geared more towards the entrepreneurship through acquisition for independent sponsors or management teams, helping independent sponsors, management teams, and minority shareholders increase their ownership stake by using less dilutive securities, and we can talk a little bit about that later today. But our principal investments are structured as sub-debt, preferred stock, and minority common equity.
Good afternoon. My name is Zach Duprey, and I work at the Provident Bank, which is a Massachusetts-based bank, and we are a commercial industrial lender, so a commercially focused bank in the Massachusetts and New England market. My role there is I'm the director of the Search Fund Lending Center. And so we focus primarily on traditional search funds, the accelerated search fund model, as well as self-funded searchers who are not looking to go the SBA route. So over the last 4.5 years in that space, we've been doing about a dozen deals a year. So we're probably at about 35 deals now in the search fund space. And again, our focus is the non-SBA self-funded searcher, but self-funded independent sponsors, accelerators, and of course the traditional search fund model.
Hi, I'm Peter Lehman with Granite Creek Capital Partners. We're a Chicago-based investor in lower middle market businesses. I'm one of the founders of the firm. We got going in 2005. Demographically, we line up, very similarly to the businesses that many of you are focused on. Companies that are in the $5 to $15 million of EBITDA range. We're looking to provide mezzanine capital and minority equity. Every once in a while, we'll do a control deal ourselves. Those have to be pretty special circumstances when we feel like we have a particular edge. I'd say what's more interesting about us than the demographic profile of who we are is more of the psychographic profile, and that we're really interested in partnering with entrepreneurs. We don't want to sit at the kid table. We don't want to be a lender who's just collecting a coupon every month. We want to be partners to business. We want to roll up our sleeves and see how we can really lend a hand in helping grow these businesses. Most of us have been in operating roles or consulting roles in prior iterations of our careers, and so we're far more invested and interested in kind of the story of a business. We, from an industry standpoint, are I'd say mostly generalists, but we tend to spend more time in niche industrial businesses and business services companies, and then there are a couple other industries that we spend a little bit of time in, but those are kind of distant third and fourth industry segments for us.
I'm Mark Procopio. I'm with Charollais Partners, and we're a secondaries buyer. So we provide liquidity to, in the search fund space or the ETA space, we provide liquidity to LPs who are investors in funds and to funds who are investors in portfolios, and increasingly to individual investors or former searchers, CEOs who have had to leave the company that they acquired for any number of different reasons, personal or professional. We tend to, we're a liquidity provider. So if, as the portfolios get managed more actively, they look to buyers like us to help them with their exits.
Okay, great. So I thought the first topic that we would cover is really just what are some of the current trends in deal structuring. Nick and Peter both offered the traditional structures that they use, but things are evolving a lot, and the mezzanine or junior debt market has evolved a lot over the last 5 years or so. That's where you used to be able to get warrants on a regular basis in deals kind of pre-GFC, and now those are very hard to find. It's more traditional, pari passu equity type of stakes in businesses as a junior debt provider. But given there are so many different approaches, I think one of the structures out there, one of the questions that you all in the room may have is, what is the right structure for me as I'm looking to acquire a business or gain a more significant equity ownership position? And so I thought maybe, Nick, I turn over to you for this question, but so when a founder or a potential searcher entrepreneur is looking to gain a larger equity position in a business through an MBO or whatever the scenario might be, how do you start that conversation with them? Because to provide a solution versus a kind of a template structure.
A big part of it comes down to the individual's risk tolerance, right? And how much money are they putting in the business themselves? So if I look at two different groups, you've got an independent sponsor who will be using all house money to finance an acquisition, and they tend to be a little bit more bullish on the company's projections, on the amount of leverage that they want to use, versus a management team who believes in their own projections but is likely been with that business through a couple of economic cycles, and they have a better appreciation for what can happen in a downturn, especially coming out of the last one. So the first conversation comes around, all right, tell us about your business, and what did the last 7 years look like? What do the next 7 years look like? Ideally, how do you want to structure this? You have a couple of options. You can limit dilution by using as much leverage as is possibly feasible. Not that we necessarily recommend that, but the opposite end of the extreme is there's a friend of mine is a searcher right now where he wants to use as little bank debt as possible. His goal is that he said he's going to put a bunch of his own equity into the investment. His entire net worth is just a little over $1 million. And because that's every dollar in the world he has, he doesn't want to turn up the cranks and put 4 turns of total debt on the balance sheet. So he wants to borrow as little debt as possible, he wants it to be as cheap as possible, and he wants to pay it off just as quickly as he can. So it comes down to that group of stakeholders and what's your individual risk tolerance, and how comfortable do you feel with leverage versus equity, and then striking that balance and structuring a transaction that works for you or for the management team or whoever we might be working with. So technically, I'm punting and saying it depends, but it really does depend on you, the individual searchers, or the management team.
And then maybe Peter, you guys are a more hands-on investor. How do you navigate structure in relation to level of involvement or seat at the table when having that conversation with a potential buyer?
Yeah, I would start with the question of how did you get the deal as an independent sponsor? You can bid the most in an auction. You can find something that's off market. You can have a strategic angle as to why you're in the position to make an acquisition that other people may not be in a position to act on. And I'd say it's really kind of models 2 and 3, which are most compelling to capital sources like us, particularly the strategic one. We're working on a transaction right now with a group that's represented here, where they are wholly committed to an industry. They have an operating partner who's a superstar, and in that case where there's kind of real value add from the sponsor, we're happy to load them up with fair economics. In the case where someone is really just bringing us a deal and they're passing the hat, you should be asking yourselves, as you're seeking opportunities of this nature, what can you do to be accretive to the ultimate outcome? You can buy a company and that's certainly a path to success. But I think in an environment where companies are not trading at low valuations, you need to find other ways to kind of justify their continued growth and the sustaining of value of these businesses through what could be continued growth, could be a down cycle. And so I would be thinking about that as the way to capture economics. In terms of like specifics on deal structure, how much debt, how much equity, everyone's going to tell you that they don't want a ton of leverage on a business, lots of equity. But I really think it is, I would agree that it's a situationally dependent outcome in terms of, the specifics of a deal structure.
Yeah. And then, maybe Zach, what about the complexity of deal structure? You're getting in at the onset of these, of the smaller end of the deal size spectrum that we're talking about here, more search-led deals. And I see everything from billion-dollar enterprise value deals where I sit all the way down to $25 million enterprise value deals, and the complexity and the financial engineering and the model for a 6.8 times levered, that's the leverage, not the purchase price multiple, in the deals on the top end of where I sit, is there's an incredible amount of complexity in those financial structures. But how, do you recommend to a searcher to keep it simple and really try to drive earnings more through, drive returns through earnings? But I'm just trying to understand.
Yeah, absolutely. So that's what you bring up is what we talk to a lot of people who come from that world, trying to bring that level of complexity into a pretty simple transaction.
Yeah.
I would say maybe the context of the borrowers we work with are typically looking at $500,000 to $5 million EBITDA businesses.
Okay.
So in that space, we're usually about 50% of the capital stack on one of those transactions. We do have some very complex credits on the deals we work on. However, for the most part, we're not trying to make it overly complex relative to the size and type of transaction we're looking at. Again, most of the people we deal with in the search fund space are recent business school graduates who decided to either do a self-funded or traditionally funded search or an accelerated search. And we're looking at similar deal sizes. Again, I'd say the majority are probably 1 to 3 million, but we go probably half to about 5 million EBITDA.
Okay.
But we try not to overcomplicate things because they are not, $100 million transactions, and I don't think they should be treated the same way as one.
And what does the amortization schedule look like in a typical, let's say $2 million EBITDA business with 10% EBITDA margins or something like that?
Sure, probably as low as 5, maybe up to 7 years total.
Okay. Yeah. And it's not a bullet at the end, it's...
No, we typically look for fully amortizing
Okay.
credit facilities in this space.
Okay. Okay, got it.
Can I ask a question of the audience? So I just want to see by a show of hands, in order to get an appreciation for the composition of this group, how many of you are thinking about a search fund? Raise your hand. Okay. How many of you are funded searchers? Okay. 1, 2. How How many of you are thinking about, how many of you work for an established private equity fund that invests in search funds? Okay, a handful. And how many of you are, once you graduate from school, thinking about doing an independent sponsor or are already an independent sponsor? Okay, and then how many of you are currently kind of C-level management at a company? Okay, cool, thank you. That's going to help us tailor our responses.
Kevin?
Yeah.
I just want to add something on the issue of complexity and the structuring of the deals. Excuse me. The other consideration I think and this is for the people who I think are thinking about doing a search or kind of in those earlier stages, a fair amount of our deal flow right now is coming from situations in which the shareholders or the investors are not on the same page. And so I think you have two different considerations. One is, how do we structure this from a technical standpoint? And two, how do you put it together as a group that's all moving in the same direction so you don't find yourself with board meetings with people screaming at each other until finally they say, wait, is there a secondaries guy who can buy one of us out? So as you compile your investors, there's that second sort of qualitative thing to keep in mind as well. Are they all in agreement with your strategy, or does some guy actually have a totally different view that they're going to have to address at some point down the road?
Yeah,
that's a great point.
That's a great topic and segue. I mean, it's a huge issue to manage your equity investor relationships, but any recommendations on how to manage your lender and whether it's junior equity or junior debt relationships, either before a deal is consummated or post-closing?
Communicate. You have to communicate with your lenders every step along the process. If the company misses earnings, communicate with them. Communicate with your equity sources, whether it's junior, whether it's subordinated debt or preferred or common. Talk to them. The more you work together with these capital sources and providers, the more you're going to understand how they work, how they think about things. We all want aligned incentives for you and for us. And the moment that we think that an independent sponsor or a management team has any interest other than the collective interest of the investor group, meaning that they want to make an acquisition or they think they're structuring because they're swinging for the fences, whereas a lot of us want to make sure we get our ball back. Again, we raise subsequent funds based on the fact that we've returned capital, returned principal to our LPs, and then any return above and beyond that is great, and certainly we want to maximize returns for LPs, but we can't afford any losses. And so the times that I can think of when we were working with an independent sponsor or a management team, when things went awry or when board meetings didn't materialize the way that we had hoped they would, is because there was poor communication.
I'd like to second that. So for a lot of the deals we work on, and pretty much our goal at the Search Fund Lending Center is really to be a long-term partner to searchers. It's not just a one and done, acquire a business, it's a transaction, we move on. So in terms of that long-term partnership, it is all about communication from that LOI when we first start talking to them, all the way through closing, and then the ongoing needs of that business and that operator's goals. That's something we want to be actively a part of. And so I can't stress that enough. Nick's spot on with that.
Yeah.
And the other thing I'd add too is it's okay to ask the question if you don't know the answer. So if you decide to pick up a purchase and sale agreement and start negotiating that thing on behalf of the shareholder group, and you don't know what you're doing, talk to your fellow co-investors about that. They will help you. Again, we all want to be on the same page. Don't assume that just because you source the deal and you want 2 or 3 seats on the board of directors that you're infallible and have to do it all. Because unfortunately, shortcomings will show themselves over time, and it's better to make sure that everybody's on the same page up front so that there's no miscommunication. And again, you and we learn through these processes all the time. There are situations where I'll raise my hand with our accountants and attorneys and say, wait, time out, I don't understand this, let's go back and revisit it. And it's made me a better investor over time, and it will do the same for the independent sponsors and everybody that's in this room. So don't be afraid to ask what you may think is a dumb question.
Yeah, any questions at this point? So while we're pausing here? Yeah, please.
Bring forth their own equity. And so one of the ideas that had been relayed to me was, well, why don't you just roll over your financing fee, right? As a search fund, you go out, you find there's a financing fee, et cetera. But let me ask you, as senior lenders and debt providers and equity folks, how does that play for you? I mean, is that valid? Does that hold the same weight as me leveraging up my own personal belongings and things like that to bring equity to the table? Any thoughts on the matter?
Yeah, we've worked on several transactions with independent sponsors where they'll take a transaction fee. What you as the independent sponsor will want to ensure is that A, you're holding back enough for taxes. But at that point, a little bit of it is house money, but it's still equity that you're contributing to the transaction post-close. Now, if you want to borrow against your 401k or you have other excess cash that you want to invest in the business, that's a great sign for us as investors because we know that you believe in the transaction and the business. So the more capital you want to contribute, the better. But also be careful on the financing fees. There are certain attorneys that will tell you that you need to delay those success fees or those transaction fees until a couple weeks after close so that the SEC doesn't look at it as a broker fee. And then ultimately the transaction could get unwound.
I would add that you should all ask your attorneys about structuring those as contingent fees as well, which would allow you to accept the cash today and delay the payment of taxes on that for a while. And so there are ways to structure that where you can take your fee in at closing and delay the recognition of that income until the exit from the deal. But at the end of the day, you got to have skin in the game, and so whatever is meaningful for kind of where the sponsor is and his or her life at that point, and kind of is reflective of a meaningful amount of capital that would cause someone to stay awake at night if there's a problem, right? That's what, when we're backing someone else, we want you guys worried that the business has hit a speed bump in some way or stewing about a challenge that you've come across in the business. And to the points that were made about communication and partnership, this is like getting married, right? I'm guessing a lot of people in the room know that you've been in a serious relationship or a marriage. Trust, communication, those are like core parts of any relationship. When you're talking about providing a company, led by a series of individuals with millions of dollars of capital, it is a version of a marriage. We are getting married around this one transaction, and we want to be very actively in communication. And if you are up at night at 10 p.m. on that complex issue, guess what? We're probably up too. Give us a call, because that's and I think the other guys up here would say similarly that that you can work out of situations when you communicate.
The other thing I'd add, just to piggyback on that, if you're an independent sponsor and you're rolling a transaction fee, there are structures, and I'm happy to go into more detail now or even afterwards with you individually, where if you can put up 5 to 10% of the purchase price, there may be a path to you individually of owning control of the business post-close. It doesn't mean you have to get it for a significantly below market valuation. It doesn't mean that you have to put up, half the purchase price. Again, 5 to 10% of that purchase price, and you partner with somebody like Granite Creek or a group like mine where we can provide all of the junior capital. There may be a path to you owning 50% or more at close where you've got board control, you've got economic control as well, and that exit timeline is based off of your plan as opposed to the equity investor's plan. And I've seen it happen a few times with independent sponsors where they'll structure a promote with a private equity firm. That promote's not in the money, but the private equity firm needs a realization because they're getting ready to go out and raise their next fund. Yeah. There was an independent sponsor here in town that partnered with a good private equity fund. Their promote was based on, I think, every dollar above a 17 or 18% IRR, then their promote kicked in, which isn't necessarily a great way to structure a promote in my mind. But from the outside looking in, It looked like it was a great transaction for everybody. They did 5 add-on acquisitions. They hired a large regional investment bank to sell the business, and they sold it at an attractive valuation. A few months later, I spoke with the independent sponsor who was looking at doing another deal, and I said, how much are you going to put into this one? Certainly you guys had a great exit. And his response was, after taxes for that deal, I cleared $60,000. And I was like, what? Whoa, back up the bus, what happened? So he shared this story with me, and it was just that, the group that had economic and board control needed to put up an IRR. And so, again, be very careful as you guys are structuring these. So as you think about classmates from Booth or Kellogg or elsewhere, folks that you can go to for money, whether it's through family connections or other executives that you've worked with in the past, don't underestimate the ability to pass the hat, especially within that mentor group that perhaps you've had and cultivated over your career, where you could get 10 people to put in $100,000 or $200,000 a piece, where collectively maybe you've got 10% of the purchase price. And we're working on a transaction right now where the management team will put in $4.5 million out of a $56 million purchase price. At close, they'll own 60%. And it wasn't an unmarketed deal. The company had hired an investment bank to sell it. They received market clearing valuations, but by using conservative senior at 3 times, sub-debt through 4 times, and preferred stock through roughly 6.5 times, that management's equity is supercharged. So if they hit their projections, they're going to get 9 times cash on cash returns, whereas our best case scenario would be 3 times cash on cash. But my downside's protected because I'm structuring it as sub-debt and preferred stock. So again, the most I'll get on the preferred is 3 times, but they'll do very, very well. And again, there's multiple ways to skin a cat, but to use, I guess, a gross analogy. But you guys have so many good opportunities. Financing the transaction is not going to be the hard part. It's going to be finding it. And some friends of mine that were search funds have gone down the search fund path and then left, and also friends that started the independent sponsor path. They thought that it'd be really easy to find a deal. They were more focused on how do I structure it, and now 2+ years later, they're finding that, gosh, it is a lot harder to find a good company, even if it's 1.5 or 2 million of EBITDA. So if I was in your shoes, which it's exciting to be in your shoes, but work those networks, because it's not easy.
Any other questions from the audience? We're happy to use your guys' questions to direct the conversation here.
I just want to follow on a little bit what Nick was saying about that story about the independent sponsor who led a, by all accounts, successful transaction over several years and wound up with really kind of no money from it when all is said and done.
Except for the management fee. Sorry, I forgot to include that. They did get a management fee to keep the lights on at their firm over those 5 years.
In many of the deals that we've seen recently, including a couple on which we're working right now, in which the former CEO, former searcher / CEO is no longer associated with the company, that happens from time to time for a variety of reasons. I've been kind of shocked at how they haven't really thought through how that operating agreement really plays out economically for them in different scenarios. I think there's an excitement at the beginning of the transaction and the securing of the capital and the fundraising that they don't necessarily think through exactly how it's going to pay them at the end. And so we've had a couple of, to be perfectly honest, unhappy conversations with sellers to say, well, look, when we go through and the bank's paid off and these guys are paid off and these guys are paid off and your class gets this and you own this part of that class, that's what you own. So when it comes back to that structuring and thinking about it through, really understand how that mathematically is going to work out for you. And I guess part of that comes into what Nick was saying about trying to have as much upfront capital under your control going in, because of course that's how you're going to get money back out again.
Right. One other situation that I've observed through some friends that have gone through the search route is, maybe it is tough to find a deal. So they finally find a deal, but it's $400K of EBITDA. And they're like, okay, is this a platform to start and do, an add-on or roll up of this kind of niche growing industry? And so the deal's small and, well, wow, it doesn't really require all that much to finance up front, but in order for it to be meaningful for them from an actual absolute dollar perspective, they really need to grow the EBITDA of the business, and the majority of that's going to come through acquisitions. But so in terms of structuring the deal at the outset, not all that complicated to raise the equity for a smaller transaction like that. But then you get to the point where making sure your equity owners and all of your investors are aligned with the vision and the value creation plan for the business, because when you go back to them to raise more capital, well, hey, it can get really complicated. Well, I only wanted to put in 25 grand or 100 grand out of the gates. And so, do you have any recommendations if it is kind of more of a consolidation or roll-up strategy? Should searchers or independent sponsors, should they overcapitalize the business in some capacity, or raise the equity through an SPV that allows for commitments of X and only a certain amount, X minus one funded out of the gates, just to navigate this potential add-on acquisition and incremental equity need later?
I've got we're in an investor in a business right now that was in exactly that situation, and they did overcapitalize the business, quite significantly. And it's I don't know honestly how the economics are going to work out for all the founders when all is said and done, but having that cash in the bank has allowed them to build new locations in addition to acquiring. And it's just made their cost of cash, it's made everything easier for them they've got a board that sits on them pretty closely and watches that cash. But having that sort of reserve in the bank already there has allowed them to expand, I think, significantly faster than they would have otherwise, if they would have had to go back every time that they wanted to open up a new location.
Right.
That's one data point, but it's remarkable how this company's been able to grow, by 40-50%, and I think it's because they've had that cash in the bank.
Mm.
What we tend to do on larger transactions, and again, this is companies with 8 or more of EBITDA, we leave enough room under the revolver so that it's relatively easy for the company to make acquisitions, small acquisitions that are tuck-in. Structure the rest of it as term debt, because that way you don't have to go back to your equity partners or sources. You don't have to agree upon, all right, what's enterprise value going to be at T+2? Now that EBITDA has gone up a little bit, is it still a 6 multiple or is it a 7.5? And how are we valuing this acquisition? Is it accretive? Just keep enough room under the revolver. Make sure your senior lender is okay with a basket for acquisitions. That would be my advice to a company owner.
Yeah, Kevin, I would say when we talk to people who have that strategy, you mentioned earlier how hard it is to find a deal.
Yeah.
So when the whole strategy is based on this business is not good enough or big enough, but it will be if we can do all these other transactions. Mm-hmm. Sometimes there's a flaw in that model right out the gate. We do support bolt-on acquisitions regularly. So with all of our search clients, they do multiple transactions over the time we work with them. But it's always easier when you're not looking for one, rather than the whole model is based on finding all of those to create this enterprise that you thought it would be.
Yeah.
Yeah. If you guys are pursuing a transaction that has $300,000 or $400,000 of EBITDA, my first question to you would be: is the juice worth the squeeze?
Right.
Think about it. All the work that you're going to put in over the next 3 years. It is really difficult to grow revenue and grow EBITDA. I think it's the opening page of Barbarians at the Gates, where Kravis is quoted as saying it takes less money to buy $1 billion company than it does a shoe shine stand. The same can be applied to think about the quality of the management teams and what you get when you're buying a little bit bigger business. Do the math, calculate the IRR, and look at your cash on cash returns, and decide if you want to work the next 5 years for 4 times cash on cash, but it's a $400,000 business.
Well, the math also is on the transaction expenses. Your accountants, your attorneys, or any other service providers you might use probably aren't charging you a whole lot less for a deal that's a fraction of another transaction that they can work on. And everybody's busy right now. Service providers are drinking from a fire hose right now. There's just a lot of work out there, and so if maybe a $250,000 EBITDA deal, you're going to do a lot of that work yourself. But just remember that you could get sunk by transaction expenses. But if you're really attracted to a company that size, it may be easy to finance that deal up front just by your own savings or passing the hat. It's a more difficult deal to sell, And the seller of that business should know that, or anyone advising that seller. And that's a great opportunity to ask that seller to help you finance that business. And if you can do it on your own with the help of the seller, then you completely eliminate some of the complexities of negotiating with your capital sources on future acquisitions or other capital events.
Can you expand on seller notes and maybe what you've observed as market in terms of number of turns of the capital structure and maturity schedule, interest rates, et cetera? Just because I think seller notes are something that a lot of people are probably contemplating in the room.
Yeah, I mean, I don't know if there's any one standard deal on a seller note, and it certainly skews more to the smaller end of transactions. We're working on a deal right now that we have under letter, where the seller is rolling over a substantial amount of equity, and then we asked him to roll a substantial amount of the consideration into one of the securities that we'll hold. We'll own the majority equity, but then we'll also have a slug of our own debt in the business. So we're an SBIC fund. I don't know if everyone knows what an SBIC fund is, but basically our largest LP is the Small Business Administration. And while we make all of our own investment decisions, we have to play within their guardrails. And part of that relationship is they want a periodic interest payment on their capital. So we're essentially our own lender in that transaction, and we've asked the seller to participate in that security, and that his portion of that is around, I don't know, 1.25, 1.5 times what we're expecting 2018 EBITDA to be.
Okay.
And it's a meaningful amount of capital that he's putting back into the deal, both as a co-investor in our security. Actually, I'm sorry, he's actually beneath us. He's a co-investor in the equity. And so he doesn't have a whole lot of rights on his debt piece. Sorry for the confusion there. But I think in a much smaller business than this one, you have a lot of latitude to ask for help from the sellers, because they don't have a ton of options. Most businesses of that size are trading to other individuals, and if you have a vision on how to make that a more financeable business, that could be a great entry point for you. And it's the realm of the business broker listing, and of course the intermediary is going to say, oh, you don't want seller paper, blah, et cetera. But they all know that in a transaction of a certain size, it's just part of the game. That said, there are complexities and opportunities on seller paper. We've got another transaction that we're working on where part of our financing is going to buy out an existing seller note. And I think the notional value of that note is around $10.5 million, and the seller is going to take $8 million today because he just wants to get his cash and be done, and he knows that his paper right now doesn't have a whole lot of teeth in it if anything were to ever happen to the business. But going back to the situation where something's going bad, what other entanglements might you have with the seller if even if that seller is an unsecured lender to the businesses financing the acquisition? Is that seller your landlord? Do you depend on that seller for any management or customer relationships? So you should also think about the complexity of some of these relationships, particularly in a small business where everything often revolves around one or two people in the company.
So Kevin, we see seller notes quite a bit on our size transactions, to Peter's point, and I would say 10 to 20% is probably the amount their note is of the overall transaction.
Yeah.
Just at a high level, 10 to 20% of the deal. I think that's one area where searchers who negotiate well and can push really hard early and often can get some really advantageous terms. I've seen ones as long as 9 or 10 years with bullet payment at the end, to ones that are very short, maybe 2 or 3 years with very high interest rates escalating. So it can be to their advantage to structure that in a nice and favorable way if the seller's on board and maybe it's a part of the legacy and they still are going to have involvement in the company and don't want all their cash up front.
And likely no personal guarantees on the seller notes, right?
That's correct.
Pledge of stock, but no PGs.
Correct.
I was just going to quickly, from a secondary standpoint, the seller is probably the first person to come and start agitating for liquidity. They're the first ones who are going to say, how do we sell this thing, or can I sell this, or where can I sell it to, or how can I? So you have to get ready to have, after a year, start fielding phone calls as to how can I sell this, where can I sell it to, who can buy it from me. I'm sorry, I didn't think you were cut off.
How would you advise searchers on creating an offering agreement that's equitable so that you can avoid that unhappy conversation that you mentioned earlier?
I'm sorry, can you repeat the question? I couldn't.
Absolutely. How would you advise searchers on creating offering agreement that's equitable for everybody so that you can avoid the unhappy conversation that you mentioned earlier?
Well, I think one, choose your investors based upon the sort of shared mindset you have with them as to the vision for the company. Don't just take the first commitments to come along because that kind of sews up your capital needs. And two, understand, model out the math through a whole bunch of different scenarios, including ones in which you have to leave the company, and that happens for reasons unrelated to performance or anything else. It just happens sometimes, and that's often overlooked, and that tends to be, kind of a big source of people looking to get liquidity because they haven't been making very much money, and so I think you need to. It's great to be enthusiastic and optimistic about into the future, but you have to also say, well, what happens if I get sick or I have to move away or something happens and what is the mechanism then for me getting out, and how is that math calculated? But I would really start, honestly, first thing is if you have good relationships with your investors and you share that mindset with them, they have the flexibility to be much more accommodating in that situation than if they don't like you.
So it takes a long time. It's really hard to find a deal. I've observed from friends that have gone the search route, it takes a long time to close these smaller deals. I mean, you're directly negotiating with the seller, or maybe a small advisor or broker is involved. But what should be, the folks here in the room, what should be their expectation in terms of getting a deal under letter to actually funding and closing?
I'm happy to go first, just because it's a conversation I had with a friend that he was a self-funded searcher, and he passed on a number of deals within his first year that would have been good enough, but he was waiting for that perfect deal. He thought he could get the next one a little bit cheaper. He thought, maybe their growth rate would be 10 or 20%, or it was more of a software as a service as opposed to something that was a little bit more asset intensive. And he then kicked himself and he said, I finally ended up doing something that wasn't nearly as good as any of the deals I saw within my first year because I was holding out for that perfect deal. The perfect deal doesn't exist, or you might have one of those in your lifetime. If you find a business that will hit the returns that you like, I would encourage you to pursue it and really put your shoulder into it.
I find that with these size transactions that were in the $500,000 to $3 million EBITDA range, the sellers are not often sophisticated, and they don't know how much work it's going to take them to get through the finish line of the transaction. And so many times they just do not have the correct advisors because it's their family attorney or it's a CPA they've used for 25 years, and they just don't have the support and realize how much they're going to need to do to support the diligence process of the buyer.
Or they're afraid to share materials and they're not willing to get someone else at the company who is closer to the financials and whatever it might be, and they're not willing to let them know that I'm thinking about selling the business. So,
right, it's very common.
How long does it take, do you think, typically?
I guess probably like 90 days maybe from LOI to closing.
Okay.
That's probably pretty normal what we see. Maybe quickly would be 60 to 70, but usually 90 to 120 from like when they first get signed up to when they actually close that deal.
Okay.
Yeah, I think it's very dependent on the sophistication of the seller. And I don't think anyone should be looking to like hoodwink the seller, in that having an experienced counselor to the seller on the other side actually will really smooth the transaction process, and probably minimize, the potential for post-closing fights, frankly. So I think that's, an important consideration on timing. I think it's also important as to your fundraising process, because conducting thorough due diligence takes time. And if you're trying to raise capital and conduct due diligence simultaneously, something is going to be cut short if you're trying to squeeze it into a overly compressed time. So on a smaller deal, I think you should be able to give yourself a little bit more runway to get something closed in 120 days instead of 75 days. And in a more packaged process, you can do that. The sellers will typically try to do some of your work for you, and your job is to decide whether or not you're there to confirm or redo. Which if you're an investor in a business, you have the right to make that decision. But typically when they have experienced and reputable service providers kind of helping package things up, then it does make that process a lot quicker.
All right, great. I think we're kind of at closing remarks. I don't know if Mark or anybody else has any other final points here, but I know everyone's planning to stick around a little bit, and we'd be happy to talk on a one-on-one basis with anybody. But thanks so much for your time. Hopefully this has been insightful to you, and look forward to the rest of the conference.